More companies are beginning to offer stocks as part of their compensation plan, which can offer a great way for employees at high-growth companies to grow their wealth. However, stock owners may come across a few stumbling blocks, such as inadvertently creating the risk of concentrated positions in a single stock if they're not regularly rebalancing and aligning their portfolios to their financial plan. Today, Rosanna and I are speaking to Ben Fredlake and Thanasi Panagiotakopoulos about how LifeManaged helps these equity compensated employees manage their finances. Here's a quick background on our guests.
Thank you, Emily. Ben Fredlake is the Director of Planning at LifeManaged and a certified financial planner professional. He works directly with clients on creating and maximizing their personal financial goals and is passionate about each client's success. With over 10 years of experience in the wealth management industry, Ben's favorite aspect of his job is to serve his clients.
And just like Ben, Thanasi Panagiotakopoulos has worked in wealth management for over 10 years. He started his career at Wells Fargo and founded LifeManaged in 2019. Thanasi is a behavioral financial advisor committed to understanding his clients' goals in order to align their actions to meet financial life goals. Before his career in finance, he actually played professional basketball in Greece. Now, Thanasi spends his free time golfing, donating to various children's charities, and with his wife and 2 kids. It's great to have both of you here with us.
Thank you.
Absolutely, great to be here.
So Thanasi, hello again. As a former financial advisor at Merrill Lynch, I saw many of my colleagues move away from wirehouses to better serve their clients. So tell us more about your decision to leave the wirehouse world and create an independent practice. What was the motivation behind that?
Yeah, great question. No, thanks for having me today. Really, the motivation was to better serve my clients. I felt like we really were working in just a big company at Wells Fargo, great company, but everything was for the shareholders, right? When you're working at a public company, as hard as we try to do the best thing always for clients, unfortunately, you work for a shareholder, right? And for shareholder pricing. And having the ability to be nimble and flexible and offer new technology or a new pricing, a new way to price the advisory model or different technology it's a lot better when you're independent because you don't have to go through 9 layers of management and go through an enormous vetting process that might be considered overkill. And so that ability to move faster and to work for the client as opposed to the shareholder was really the biggest motivation. The other piece was just, as a young professional, and when I started the business at 25, our natural network and who we get along with and can relate to is our peers. But there really was no option to serve our peers at a big company because it didn't make sense for the profit model. A 25-year-old that's just starting doesn't have $500,000 to invest and pay a fee. And so being independent really allows us to change the way that we can charge these young professionals and give them quality advice, as opposed to some of the other options that was available, like, working with an insurance advisor, maybe posing as a financial planner, that would somehow the result of the plan would end up with a life insurance sale so that they can get a commission and be compensated for their time, or maybe more of a regional where they have lower minimums, but it's a more transactional process rather than a consultative approach.
That makes a ton of sense. The part about serving your clients with flexibility and transparency especially resonates. And now you call yourself small but mighty, and you've built this great team, but as a small team still, without the in-house resources of a wirehouse, how do you provide that level of service and trustworthiness that you referenced?
Yeah, no, that is a big point that we have to educate everyone on, because sometimes people say, well, there's 3 of you, and like, who's LifeManaged? Like, I was going to write a check to LifeManaged, no. And so the way that the custodians have positioned themselves and outsourced operations groups have aligned themselves with us so that we can have huge resources. So first of all, by partnering with Charles Schwab as our custodian, we have all of the access and full capabilities and security of Charles Schwab. I mean, they've got trillions of dollars that they're responsible for. So we get to piggyback on all of their technology and offerings. And then at the same time, by partnering with a firm that we partner with, Dynamic Wealth Advisors, who is our registered investment advisor, they have over $2 billion in assets and a 30+ employee operations team. We get to use their technology and their resources so that we can spend more time focusing on the client as opposed to worrying about, what's going on with Salesforce today, or why isn't Charles Schwab, responding to a DocuSign, or what, we have all of the help that we need rather than bogging down on the operational items.
I think another thing we really like being independent is we can partner with Just Invest. You guys are really nimble, and you can help us fully automate the process so that, we can look at these tax loss harvest options on almost a daily basis, and just, again, embrace that technology, make it simple, and make it a really clean solution for somebody so that, they don't have to think about it. It's working in the background, and, we can focus on other things that are ultimately, more important or top of mind to folks.
Right, that makes a ton of sense that you can partner with someone in order to cut out some of that compliance work. So there's a saying that fortunes are made through concentration and kept through diversification. You're focusing on helping equity compensated employees who definitely have the concentration part of this quote covered. So Ben, can you tell me more about the challenges that these clients are facing and how are you helping them?
Yeah, absolutely. It is a big challenge, and it can tend to be pretty overwhelming for them. So as Thanasi mentioned, Dynamic is one of the resources we use, as well as the strategy through Just Invest, to ultimately help clients be tax efficient with their strategy around how to get out of concentrated positions. Because a lot of times that's their biggest concern. Hey, I know I've created a tremendous amount of wealth, but I know I have a tax problem. Maybe they understand it, maybe they don't. But what we really do is say, here's a really good strategy to start to offset the gains you've had in your concentrated position, and have a specific next steps on what to do with that money. Because oftentimes it's great, I know what my tax might be, I know that I can sell this at these intervals, but then what? What do I do? And that's another reason why we love using the Just Invest model, because number one, it's automated, so we can kind of set it and forget it and let the tax efficiency over time, tax savings over time, really compound and build for somebody. And then it gives the client, a tangible strategy to look at, which is also important, because it's our belief that, over time, it's very difficult to beat a benchmark, and active management has proven to be historically expensive. So if we can own the index, make a tax efficient solution for somebody, and then give them diversification on the back end, I mean, that is exactly what we're after. So clients really like that strategy, and it's definitely a long-term play, but that's sort of what we're about, controlling the controllables, as we like to say, and controlling your own destiny around income and expenses, and then letting the investments be part of the plan to help, augment it and not drive what we're doing holistically, really is a nice piece to offer.
Okay, that's great, Ben. That's a really great overview into how it works. But can we talk a little bit more about the nuts and bolts? How does it actually work when you're transitioning from a concentrated position to something more diversified?
Yeah, let's go a little bit behind the scenes, because if you are that lucky tech employee with, a bunch of restricted stock, and now you've got high market value, low basis, and you need a plan to get out of that, what do we do with you? And how do we keep you invested and aligned to the benchmark while also helping you tax loss harvest along the way? So we always want to look at how are we managing taxes. And so therefore, we're going to begin with selling maybe a part of your stock. And typically we want to try and do this at the beginning of the year so that we have the maximum amount of time for the portfolio to realize losses to help offset gains. But we're going to take a look and say, okay, if we want to match a global benchmark, let's get exposure to the Apples in technology. Let's just say the Apples and Microsofts and those companies. And then slowly, as time goes on, we will take losses in other parts of the portfolio as we sell off those positions. So I think you have a slide up here where, over time, we will transition to the full strategy, but we're going to be tactical about what we're selling when. And then as the market tends to do and goes up and down, we'll be strategic about saying, okay, now's the time to harvest losses, sell some more of that stock, keep your exposure to technology, let's just say, but still continue to be invested along the way. So we can take advantage of keeping invested, harvesting losses, and ultimately in the long term saving on taxes to get to that full transition now where you're set up with a full separately managed direct indexing portfolio.
That's great, Ben. Controlling the controllables, and I was just writing that down. I really like that, and how that applies in financial and investment strategies as well, just given how volatile everything is. This is where a sound strategy really matters. Back to you, Thanasi. You've been working in the wealth management space for quite some time. Speaking of trends, and we are going through a very exciting time right now, what are some of the trends that you're paying attention to these days?
Yeah, thanks. Yeah, it's a quickly evolving field, especially with so much competition and consolidation and with technology changing. And aside from what Ben talked about with technology, I think in my Wells Fargo days, we were focused more on security selection or maybe product selection as opposed to the technology and how that fits in. And so by partnering, by having that dynamic wealth, having the ability to vet strategies like Just Invest, where we can lean on them and offer that technology, because with Charles Schwab, we have $0 trades. And so as costs have come down, it makes these more appealing to the end investor. And so the technology would obviously be a huge shift that we're focused on, especially with the client experience, having a very frictionless onboarding process, and then having the full data aggregation so a client can see their net worth statement as frequently as they want, can measure their progress, and we can get an asset allocation picture with all of their accounts everywhere held even away from us. Kind of brings us to that other shift of assets under management maybe versus assets under advisement. And if you think about historically, even if we back up 30 years, maybe 40, I don't remember how far this goes, but you used to have to find an ad in the newspaper for a local Merrill Lynch broker, that you could buy stock through them and pay them a hefty transaction fee because there was nowhere else to get it, right? And so it was kind of a stock broker back then. And then, you had life agents, sales agents, and then it kind of started switching to this idea of wealth management, where they were more holistically or comprehensively helping their clients plan. And then from wealth managers, they started calling themselves financial planners or fee-based advisors. And I think at the top of this paradigm shift would be this assets under advisement, or this fixed fee retainer-based planning is where I think we're really trying to get in front of. If you look at how an accountant or an attorney is paid, they're not getting paid a percentage on every transaction. They're offering by the hour. And so there's a big shift with young advisors that are willing to do work based on a project, for a negotiated fee. Hey, what's the complexity? Here's what it'll cost you. We also have now the actual monthly retainer, or more of we're looking at your entire picture and we can report on all of your money. If you have a Merrill Lynch guy, an Alliance Bernstein gal, and then you have an independent money manager, but you don't have anyone to tie all this together, we can report and aggregate all the data and keep all these people in line and have the actual comprehensive plan for the client for what their lifestyle wants to be. And then moving to these young professionals, you know, when you look at that trend, you know, they do like to do some things on their own because of technology, or they have concentrated stock positions, so there's not necessarily anything to manage, so there is no AUM fee. But what we can do is look at their situation and look at what are they in need of, what kind of planning. Is it tax planning? Is it the estate planning? Is it general personal financial coaching, which we're finding is a huge need? And it's just understanding, well, what do you want out of life? Like, why are you working? What does money mean to you? Because obviously money is a resource that's part of our daily life. And so if we can help understand where clients use that resource, then we can put the actual taxes, the estate, the budgeting, the health benefits, the concentrated stock positions, or the incentive stock option, or the RSUs, or their employee stock purchase plan, and put it all together. And we could do that without managing $1 or charging an asset fee. I think that's a major trend. And obviously there are resources, you know, I know we use Advice Pay, which is a Michael Kitchis tool that makes this easy for clients, and it also makes it easy for advisors, so you don't have to worry about the whole billing and when do we bill you, and okay, we're not going to provide service before we bill you. You know, we take a lot of that risk and believe in our process. We start doing that work up front. It could be 10, 15 hours up front before we even get our second monthly bill. So even if we quote someone for the year, it is a monthly fee that we allow our clients to stretch, and we take that risk. We don't have a contract with them. Like, they can take the value and go away if they wanted.
Well, you know, just a quick point there. I mean, you are paying it forward and trying to set up the stage for your clients, which is super important. And, you know, I think with how people work these days, and as they're looking for the right opportunities, they're switching jobs more often, you know, which means more accounts are being opened, more 401ks, more and more things to be consolidated. So just streamlining everything is a huge value proposition ahead of actually figuring out how to plan for their financial strategy.
100%.
So then, yeah, that's a very, very strong value proposition.
Yeah. I mean, that's what Ben and I talk about this all the time, is working through that value proposition. And I think it's the organization. It's just offloading unpleasantness. People just are like, I know I need to do this. I need help. So I just don't want to do it. And I understand how finance works, and I like investments, but I'm better off managing my sales team to hit our bogey so that I can get more stock, and that stock's valued higher, and rather than worrying about the little details, right? And then sometimes it's easy, even just like to help people take action or reduce that complexity, or those are some of the value props that are completely not tied to money at all. It's just emotional intangibles that it helps people move forward with a plan.
Right. And that's such great insight on how you can help young professionals without actually managing their money outright.
Right.
And so, transitioning slightly, another trend that we've noticed at Just Invest is actually this evolution from actively managed funds to passive investing with mutual funds, then ETFs, and now direct indexing. And you've kind of touched on this. So Thanasi, can you tell me a little bit more about your thoughts on this evolution of investment solutions? And what does it look like at LifeManaged?
Yeah, I mean, we think if you think about where the investment options have gone, you know, it was a lot of individual stock positions, and then mutual funds obviously were a big part of that. But then, you know, you used to tell clients, well, you don't want to hold mutual funds if you're in a high tax bracket, because you get this unforeseen capital gain distribution, or maybe you're bound to get them, and you can look at a mutual fund's historical distributions and see, are they effective, or is there high turnover? But at the end of the day, you want to be in charge of your own tax events. right? You don't want to get that cap gain and then try to react to that later. And so that's where the ETF tax efficiency story really grew, was a combination of, well, we have all the data. You know, you can look at the SPIVA reports and see that over a 10-year period, I think, 80 or 90%, depending on which asset class, are underperforming their benchmark. So the rise of the passive management plus that tax efficiency made ETFs very appealing. And then throw on a $0 trade, and in comes all of the ETF exposure and the vanguards, and it makes sense. But we think that this direct indexing is the best of both worlds, because it is still that passive story. We're looking to our client and understanding, what are we building towards? And by the way, is this an ESG minded? Is this a social responsible investor? And being able to put those customizations into the portfolio, which is becoming an important theme for some of our clients and for young professionals in general. So when you can add that, and you can get the broad exposure to the Russell 3000 or the global ACWI, whichever index that we want exposure to, not only do you get as much of that participation in the index return, but you also minimize that tax burden and hopefully have an increase of that after-tax return by creating those losses on an annual basis moving forward, right? And who knows how that plays out year over year, but in an ideal world, you have your money growing while your basis is also rising, right? And that's where that after-tax return plays. And that's kind of that institutional mindset, where that is one thing you can control, is let's instead of it being a pedal to the metal, all right, we're going to get 10%. Well, let me see, what was your after-tax return per level of risk to earn that 10? And if we can juice that after-tax return, that's where we feel like we can influence our client outcomes.
Right. That makes so much sense. And I think a lot of people underestimate the effect of taxes on their outcomes.
Absolutely.
So I have one final question before we wrap up here. A lot of investors do manage their money independently, especially now that fintech companies like Robinhood have made it easier for anyone to invest. So at what point would someone actually need a financial advisor? And where would you step in? Thanasi, would you like to answer this?
Yeah, sure. No, I think it's awesome that so many people, like what this pandemic did was move that forward, because people were at home, whether it was extra time, some people extra cash, depending on what kind of business, or stimulus money that they didn't want to spend. And then plus the technology, it kind of was this perfect storm of more investors getting in, plus the fact that the market was down 30+%. It presented an opportunity for people to actually get involved, which I think is awesome. The one piece is that the big differentiation, I think, is that we are not investment managers only, and we're not stock traders, right? We're having lifestyle planning discussions. And I think that's when we step in, is when people are having life events. I mean, that's really the ultimate time to hire a financial planner, maybe a job change or a new job opportunity, that they're giving you a stock plan and you don't even know what an ISO is, because you were an employee with no stock ownership. And now you're kind of weighing the cost of, well, my base salary is going down, but I'm getting the stock. And how does this play out? And what's the actual likelihood that this company and this technology will become worth something to take that risk, right? Or should I now, in a gig economy, I mean, you see what's going on with Fiverr and Upwork. The side hustle is going to be growing a lot as people are realizing, I can't just make it with 2% raises a year. I need to make more money, right? I can only pinch and save so much. Those discussions with that consulting income comes in. What do you do from a tax planning standpoint? And then where can you invest the proceeds or your earnings there in a tax efficient way where you might not have had that capability before? or, get married, merging your money with your spouse, maybe receiving an inheritance, or having that liquidity event where you were a $100,000 a year employee, but your stock just IPO'd and now you have $1 million that you never thought you would have. You're kind of going, I don't know if I'm going to throw $300,000 in Tesla. Maybe I should talk to a financial planner before I Robinhood trade this, right? And so, or mortgages, like if they're buying a house or considering doing a refinance. Right now is open enrollment. We look at that as a lot of people are still unaware of how a health savings account can save young, healthy people a fortune over the next 30 years if they understand why and how that works within a financial plan. I could give 25 more examples, but for the sake of everyone's time, I think that could be enough.
Well, those are some really good examples already to highlight. And obviously after this interview, we will make sure that our audience has your information to reach you, so that they can ask more questions and hear more scenarios to see how it can apply to their existing situations. Thanasi, Ben, it was great having you with us today. We hope this episode will help investors who might be feeling a tad bit overwhelmed with their finances. There's so much to learn. If you'd like to learn more about LifeManaged, you can visit their website at lifemanaged.com. To our listeners, thank you so much for joining us. To learn more, check out Just Invest's website. You can also follow us on LinkedIn, Twitter, and Facebook. This has been Rosanna and Emily with Ben and Thanasi from LifeManaged. Investing done just right with Just Invest.